Well, good day to you. So I've got an interesting one today. I get asked about reverse mortgages and reverse purchases a great deal. Um, Most people don't know that you can actually use reverse mortgage to purchase a property. And in this example, I'm going to use the concept that you have $1 million in your investment property. You've sold your lifetime home and you're looking to buy a retirement home. So most people think when you sell your long-term home, the best thing to do is to pay cash outright. So we're going to assume that whatever monies were made from selling the home went into this investment balance of $1 million. So that includes that total. Any investments they have, plus the proceeds from the sale of their home, they have $1 million. So this is what we're going to do. And then I'm going to compare the long-term ramifications for your family's wealth, paying cash up front out of that $1 million, buying it with a reverse mortgage by paying against the principal limit straight ahead, and using a traditional 20% down conventional mortgage. So obviously these are all estimated numbers, but it gives you a really good idea. I'm using the average appreciation rate for the S&P 500 at 9.327%. So any monies left in the investments are going to assume to appreciate at 9.32%, 327% per year. I'm going to estimate your mortgage at purchasing a $675,000 home with 20% down leaves a mortgage balance of $540,000 using a 6.875% conventional mortgage rate, which is about where it's at these days. Will give us a monthly payment of $3,547. So I'm not taking into consideration property taxes, HOA, homeowners insurance, any of that in this principal and interest. It is literally only the principal and interest payment of the property. So we've got $1 million. We've got two borrowers. One's Jane, one's Steve. Both of them are 65. A reverse mortgage, the amount you'd have to put down to buy out the equity of a reverse mortgage is based on the purchase price / appraised value against the age of the youngest borrower. So in this case, we have a principal limit of $255,000 right now, which means that they would need to bring the difference between $675,000 and $255,000, which is the principal limit. That gives you a leftover balance in your investments of $580,000. If you pay cash, the balance is $325,000, and if you paid with a conventional 20% down, you'd have $865,000 in your investments on day one. Another couple things that I'm looking at is that the expected property appreciation rate is 5%, and your annual distribution amount out of your investments is 6%. So those are all important numbers to use in conjunction with this, but it gives you a good idea of what happens. So again, in any of these scenarios, we start off with $1 million. We're going to pay cash for a $675,000 house. We have about $325,000 left over. We're going to buy out the equity of a $675,000 house. Means the balance of our investments is going to be about $580,000. And then if we're only putting 20% down out of that $1 million, on a conventional loan, we end up with a balance of $865,000. So, especially in a down market, let's look at what happens when you leave your monies in the account. So age 65, 66, 67, etc. So we're going to assume that this particular borrower lives for another 30 years, which is fantastic. And when they leave the planet or need to sell the house or otherwise distribute their assets to their heirs, they're going to have three options here. So if they paid cash for the home, the remaining in the investments is going to be about $4.3 million. Not too shabby, right? That is good. That means you can distribute that with the heirs along with the equity in the property, which is calculated over on the right. I'll get to that in a second. You end up with the net worth of $7.09 million to the heirs, which is fantastic. Okay, the next option is reverse mortgage. Again, we bought out the principal, the required equity from the property up front. So we started off with, almost double in our investments up front. So our final equity in the investment in the investment accounts is going to be just under $14 million. The net equity in the home is going to be a little bit lower because remember, we didn't make any payments for 30 years. And every year the payments that you don't make, the interest that accrues gets added to the mortgage balance. And so on a reverse mortgage, I'll go to that in a second, but the net equity after you sell the house is 1.4 million. Your net worth is 15.2 million in this example. And then under a conventional loan, again, we put 20% down. It's at 6.875%. We paid the mortgage off over 30 years, paying $3,547 per month. At the end of 30 years, your investments will be worth $5.9 million, or just under that. The net equity in the home, because again, you paid it off in both column A and column B here. If you paid cash up front or you paid it off in 30 years, you've paid off the mortgage, so you own all that equity, $2.76 billion, which means your net worth is $8.644 million. So let's go through how I determine that. So property value, there's a couple columns here. You started the property value at 675. It appreciated at 5% per year. And after 30 years, that property value at an annual appreciation rate of 5% should be worth about $2.8 million, give or take. So that's kind of how that. Same concept with paid cash equity. The number's the same, right? With a reverse mortgage, you started with a balance on the mortgage of $255,000. And every month you didn't make a payment, it gets added to it. So over time, the balance on the reverse mortgage creeps higher. That's how it works. So at the end of 30 years, the balance of your reverse mortgage is $1.38 million, which again, the house is worth 2.7, subtract the 1.38, and that's where you get down to this number, this 1.395 right there. Conventional balance, again, start with 540 because we did a 80% loan to value, about a $675,000 house, put 20% down, so we started with a loan balance of $540,000. And every month, diligently for 30 years, we made payments. And by the time we get to the end of 30 years, the balance is zero. So a little rounding error here, but close enough. Gets you to zero, and then that gets you owning the entirety of the equity of the property. And that's how you get to this. So in the end, the devil is in the details, that in any scenario, if when you're 65 years old, you buy a $675,000 home, you're going to end up having some good money to your heirs. That's if you started with $1 million, you bought a $675,000 home. In any scenarios, your heirs are going to have a good chunk of change if everything else plays out normally. If you do a reverse mortgage, it's roughly double the other scenarios because you're not making any monthly payments. You can, but you don't have to. And that money is being added back into the amount that you're investing. So that's why these creep up so quickly, is because you're reinvesting that $3,547 per month back into the investments because you're not paying that as part of the mortgage. And the amount of equity that is added, or the balance that added to reverse mortgage, just the interest rate is obviously lower than that. So it's a great scenario. It gives you a lot of options. You know, the good news is if you do start with $1 million at age 65, you've got options and your heirs will probably do quite well. The nice thing about doing the reverse is you end up significantly better off from a monthly cash flow standpoint than going conventional. Go conventional, you're going to have to pay off that $3,547 per month, and that has to come from somewhere. It will probably come from your investments, or from your Social Security, or from pensions or annuities, something like that. With a reverse mortgage, there is no monthly outlay. You are not making a monthly payment. There is no monthly payment that's required. There is a payment required when you leave the house, sell the house, otherwise leave the planet. That is required, but up to that point, you do not need to make payments monthly if you don't have to. Still have to keep property taxes current in any scenario. Still have to pay homeowners insurance in any scenario. If there's an HOA, you still have to pay the HOA in any scenario. All those things are equal. That's why I didn't include them in the numbers, because they really don't matter. Those are equal numbers for everything single tool. In my opinion, the smartest thing to do is sit down with your financial planner when you're considering buying a new home in retirement and go through this concept. In the end, the numbers don't lie. Even at meager appreciation rates, you will always end up in a better situation for your family purchasing with a reverse mortgage. Thanks. Have a great day. Again, Charles Davis from Nexa here to help.